Good morning, everyone. Our top story this Thursday morning. The Fed has delivered an expected interest rate cut, reducing rates by 25 basis points to their lowest level in 3 years, with its statement citing increased risks to the employment outlook. But the decision exposed divides within the central bank. 3 policymakers dissented on the decision for the first time since 2019. 2 said rates should have been kept on hold. And, of course, Trump appointee Stephen Myron calling for a 50 basis point move lower. That uncertainty was also clear in the all-important dot plot projections, where 6 of the 19 FOMC members indicated they supported a hold in this meeting. For 2026, the median forecast showed 1 rate cut that's in line with September's projections. But 7 members supported no further easing, while 1 suggested rates should be 150 basis points below their current level by the end of next year. The chair, Jerome Powell, said the Fed can wait to see how the economic outlook develops. Listen in.
When the risks to the 2 goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. We now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
In addition, and perhaps this is one of the most interesting aspects of the meeting yesterday, the Fed also announced on Wednesday that it will buy $40 billion in short-term treasury bills over the coming month. This is in an effort to stabilize funding markets, just weeks after ending its quantitative tightening program. Powell said the move will not mark a return to large-scale debt purchasing and is not being used as a monetary policy tool.
Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves.
So that was the update from the Federal Reserve. In terms of the ECB, we also heard from Christine Lagarde. The president of the ECB said European rate setters are likely to lift their growth outlook in the next week's meeting, which would mark the 2nd straight upgrade to the forecast. Speaking at a Financial Times event, Lagarde also said that the euro area is performing better than the ECB had expected in the face of President Trump's tariff policies. And this gives us a good segue to look at how European futures are faring at this hour, indicating perhaps a flat start to the trading day, continuing ultimately the sentiment that we have witnessed this week so far. And this despite the fact that now we know the outcome of that Federal Reserve meeting that investors were wondering about. So let's see what will happen later in the session. And indeed, if we're going to get a little bit more clarity in terms and conviction, ultimately, in terms of how European investors are positioning themselves. Let me take you to the dollar crosses too and show you how things are moving in this part of the investment world. At this stage, we're not seeing also huge swings when it comes to some of the moves between the greenback and the European currencies. But of course, this is also an important asset class to look at in the context of the outcome of the Federal Reserve meeting. Speaking of which, let me show you how markets have reacted on that as well. This is the close. This is how Wall Street closed yesterday. As you can see, though, we actually ended the day on a positive note. The Dow, for instance, up about 1% on the day. But let's get a check on how things are faring as we approach the open later today. Look at it. Futures actually indicating that we could see a slightly negative start to the trading day, in particular for the Nasdaq. And we'll be discussing the reasons behind that later in the show. But this is related, just to give you a little bit of a tease here, it is related to some of the comments that Oracle made yesterday as well. But broadening out the conversation and looking at what else we heard in terms of that important Fed decision, we had the chance to speak exclusively with the Bank of America CEO, that of course is Brian Moynihan, in the wake of that Fed decision. And he told CNBC that he expects to see further easing next year. Listen in.
We get in this great debate about a quarter here, a quarter there. But if you think about it overall, there's not a lot of debate about getting it down around 3%, but no lower. That people have to focus on, because that's a different rate environment that will have a 3%.
So a lot to digest after that Federal Reserve meeting. Let's discuss it with our next guest. He is Andrzej Szczepaniak, Senior European Economist at Nomura. Andrzej, always great to see you. What did you make of the meeting?
Good morning. Look, in some sense it was mixed. The actual decision itself, the rate cut, that was widely expected. Most analysts, markets were pricing it. It was very widely expected. In terms of communication, though, that was slightly more mixed. You did have some commentary by Powell, as you mentioned, regarding the labour market. That was slightly on the dovish side. However, he did set the bar a bit higher to future rate cuts. He spoke about the fact that now, actually, the policy rate is within the range of neutral for most of those on the FOMC, and the Fed can take its time to wait and see, essentially. You have this scenario as well in the SEP. There were meaningful revisions upward to growth for next year. So you have actually a strong US economy in some senses on the growth side. Risks the labour market is turning. Even though the SEP didn't show a rise in the unemployment rate, he nonetheless expects revisions to non-farm payrolls to be negative once those revisions from the benchmarking come in. And in terms of inflation, actually, he spoke about how core PCE is in the low 2s if you actually take out the impact from tariffs. So our US economists estimate tariffs have added 30 to 50 basis points to the annual rate of core PCE due to tariffs. And so that's what Powell says is very plausible, but it still paints a very challenging picture. And likewise, you saw in terms of the actual vote split, there were a lot of dissents. Not just actual dissents, so also tacit dissents. Those who still voted for a cut, but actually in terms of the dot plot, suggested they would not have voted for one otherwise.
There are just so many angles to this rate decision. What does it say in terms of where we are in terms of the health of the US economy?
I think Powell was very clear that a lot of the technical factors, so owing to the government shutdown, means we just don't know at this stage. You have a scenario whereby tariff price pressures have maybe been more muted over the course of this year than many analysts had expected. The US economy, from a growth perspective, has been resilient. Consumers have been resilient. It's true that now with non-farm payrolls potentially going negative once you get those revisions in, the labour market is clearly weaker than we had sort of thought maybe 12 months ago, but it's not sort of crashing in any sense of the term. It's simply a more meaningful slowing versus prior expectations. In terms of sort of outlook going forward, we essentially think the Fed will cut twice more in 2026, so in June and in September, so broadly in line with market pricing. Markets, I think, are at 48 basis points by cumulative by September. But it's a case of you have a scenario whereby during the first quarter of next year, inflationary price pressure should ramp up, we think, owing to further tariff price pressures. Growth should remain resilient, and the labour market shouldn't turn too meaningfully, which makes it very challenging. The question for many on the FOMC is, which policy mistake could you be entering the phase of? Are you actually in a scenario whereby you need to slow the pace of cutting rates to ensure you sort of get behind those price pressures and sort of essentially curb any of those price pressures further? Or are you in a scenario whereby the labour market could turn more aggressively, like Moran, for example, thinks, and potentially Waller to some extent, whereby you have to cut more aggressively?